Joining me now to discuss this and other trends is the Chief Investment Officer for Citibank Private Bank. That's Richard Cookson. Richard, thank you so much for coming in. Now, you know, we're seeing a sell-off today. We're expecting that inflation report here in the UK. Still a lot of concerns on whether we're going to see a double-dip recession in the UK or not. Are you cautious on UK equities?
A little bit cautious, but when you're talking about UK equities, you're not actually talking about the UK economy because it's so much international exposure there. And the FTSE is dominated by energy and commodity companies and financials. So really, what you think about the UK stock market depends what you think about those. And they are rather subject to international rather than UK trends. But
Richard, in general, I mean, if you look at the equities, we're seeing quite a sharp sell-off today. And what we're seeing is people still seeing varying uncertainties on the world economy. We just came out of the IMF, but at the same time, all this liquidity being put on the markets. I mean, what does it mean for the future? Are we going to see a sharp correction?
Well, I think the way to think about it, Francine, is that everyone's been looking at the good side of QE, not the bad side of QE. QE is, in effect, a devaluation of your currency, assuming you do more than the opposition, right? So, and what you were seeing at the IMF conference was the bad side of that. In other words, what's happening is that the US is effectively debauching its currency, but it's taking down the renminbi with it. So you basically got the two biggest economies in the world passing the buck to everyone else, and that's the problem.
What does it mean for you, for equities in general? I mean, as an investor, what's your portfolio at the moment?
Okay, so what it means is that one, I would think, would want to pair one's exposure into this rally. As you say, it's a very unstable situation, and it clearly investors over the last few weeks have been taking the plus from this, but there's, as I say, there's a big minus from that.
So how much in equities are you invested? I mean, do you keep more cash than you did just 6 months ago, for example?
No, we're pretty much neutral in equities at the moment, but our positions mainly are in core Europe, in other words, Germany and France, because they're so astoundingly cheap compared with, say, UK or US. We also fairly like topics. But in general terms, we are pretty cautious on equities. We don't have much cash. Most of our positions on the fixed income side are in either credit or in long-dated government bonds.
What about commodities such as oil and gold? We actually had some breaking news in terms of oil. We spoke to the Libyan official, Shakir Yanim, saying that he'd be happy with oil at $100 a barrel.
Yes, I'm sure he would.
They would, wouldn't they?
Look, again, the whole point about commodities is twofold. And again, you need to divide them up between industrials and precious metals. On the industrial side, clearly there's an effect of a weaker dollar. So the Fed prints more money, or the Bank of Japan prints more money, and therefore fiat currencies lose some of their worth against hard assets. So there's that going on. There's also the question of what China's doing. Now, China is the determining force of industrial commodities. And you can see this just in the numbers very easily. So if you look at 1999, China accounted for 7% of all global demand for industrial commodities. The figure last year was 46%. So really, that's a call on what China does. We saw this morning that they are trying to clamp down.
Yeah,
exactly.
Okay.
So that I'm a little bit cautious there, short term anyway.
Richard, thank you so much. Richard Cookson.